Today we are analyzing HollyFrontier Corporation, ticker HFC. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, we have a market cap of $5.9 billion, enterprise value of $8.7 billion. So you see about $2.5 billion in net debt on this business, which is quite significant because the enterprise value is only $8 billion. So you're talking about 30%-ish of the enterprise value being debt. That's quite a significant amount. So I have some initial concerns on that piece, but this company is in the oil, gas, and consumable fuels industry. So they are an independent petroleum refiner. So the key word here is, of course, refining. The company has three segments: refining, lubricants, and specialty products, and HEP. Primarily produces high-value light products such as gasoline, diesel, jet fuel, lubricant products such as specialty and modified asphalt, and it also offers products to other refiners, convenience store chains. So it's basically selling the refined oil. So the refining here is key. This is a specific segment in the oil and gas industry. It's not an exploration company. It's going to matter on stuff like frac beds and refining, where they are basically taking the oil that someone else has already gotten. They're buying the oil from that oil producer, and they are refining it and producing a few downstream products like these lubricants and specialty products. So it's a very unique slice of the business. A lot of the major oil companies, might have multiple phases in this, or they might be single focused on one area, but this is what it is. So it has 4 refineries with crude oil processing capacity of 405,000 barrels per day. They have El Dorado, Kansas, Tulsa, Oklahoma, Artesia, New Mexico, and Woodcross, Utah. So it has some distillation and other facilities, and its markets serve the mid-continental. Basically, they're on the U.S. though. So very U.S. focused. I don't see a beta here for my data here, but very high share turnover, 421%. Now, return on invested capital. You had some very impressive numbers, 62, 63% returns on invested capital in 2006, 2007. But before that, they were 12, 15, 16, 31%, all very good numbers, 10% in 2008. They bottomed at 0.9% in 2009, but stayed profitable all the way through the financial crisis. 2011, 2012, they had 19 and 21%. They got 8, 3, 9. They did lose money in 2016, and they lost money in 2020. Now, the COVID one I'm not really worried about, but of course, also 2016 was one of those years where the oil market took a big downturn, and so that's also not understandable why they had that turn. It feels like during the non-downturns, they actually have really good results. So you see 9% here 2017, 11% 2018, 2019 8%, and they're bouncing back up quickly to 5%, even though after that year. They do bounce around a lot. That is a little bit of a concern. You do see some cyclicality here. You see these ups and downs. You never really like cyclicality. That's not unheard of. Even though the refining industry is going to be a little bit different than the overall oil and gas industry, they are impacted relative to each other. Overall, there's nothing super concerning here. They lost money in 2 out of the last 20 years, so they had 18 years of profitability. That's a pretty good number. I'd say it's kind of falling in the average bucket so far. Of course, high quality, I like to say, is 19 or 20 years of profitability out of the last 20, and they kind of miss it with these 2 years of losses. Overall, though, pretty good numbers here for a cyclical company. So return on invested capital, average of 8.4%. Not bad, but not great. Return on equity of 11.5%. Not bad. Of course, you're seeing that boost there because they have that debt leverage on the business. However, we start to get some really exciting news when we look at valuation. PE of 10, price to book of 0.9, price to sales of 0.3, EV to sales of 0.5. So these are all saying, hey, this company's probably cheap. Cheap company at an average company at a cheap price can still be really attractive as a potential investment depending upon how these numbers work out. And depending upon how the business is being capital allocated and what they're doing in terms of discipline about acquisitions and other things. So anytime your the average PE of an average stock in the S&P 500 trades a PE of 15. So we're saying, hey, this is an average S&P 500 stock, but it's trading 30% less than that at a PE of 10. That starts to get really attractive for you as a potential shareholder because you can get a cheap price. And anytime you have that extra capability for it to boost, a 50%, if you say, hey, it takes 10 years to go from PE of 10 to PE of 15, that's going to add 3 to 4% to your return just due to that multiple expansion. So that can be an attractive way to set up your investments if you can get that boost on top of the fact that you start out at an earnings yield of 10%. Pretty easy to see how you can get a double-digit return depending upon how their future plays out. Now, the revenue, you begin at $20 billion, you end at $18.3 billion. So you can see that the revenue has declined a little bit over the last decade, but it spends a lot of time, flat, year to year, 2012, 2013. They went down a little bit in 2014, went down again in 2015, went down again in 2016. So you see 3 years in a row as that oil market got worse, their returns were declining. declining. They actually had a really bad year in COVID, but of course that was COVID, so I'm not super concerned about that. Positive operating gross profit. They did lose that operating profit number in 2020, but they kept positive operating profit in 2016. So it makes it look a little bit better than what I thought before. One of the problems with commodity businesses, though, is you see this gross margin is not stable. 19%, 12%, 9%, 18%, 16%. If you think about a lot of the companies that I like that really hit the watch list, they have stable gross margins. Something where it'd be like 19, 18, 19, 19, 20, 18, 19, 20. Anytime where it stays really stable, that means the business is more predictable. The company has a little bit more pricing power. That's what I really like to see because it makes it easier as a shareholder to predict the future. We don't have that here. In fact, on the operating margin, you see the opposite here. It's even more unstable. 14%, 6%, 2%, 9%, 5%. The fact that you can go from 14% to 2% in a 2-year period shows just how volatile it is. Even though the revenue didn't actually change that much, it's really moving along in terms of their expenses and costs. Not very predictable business. Again, not abnormal for an average business, but it's just not predictable. Now, you began the decade with $8 earnings per share. You're ending at $3.39. So let's see. You see $3.39, $36. The nice thing about this, though, is like, okay, you have a cheap price of $10, right? There's a lot of years in here where you're earning more than the most recent year. So you earned more in 1, 2, 3, 4, 5, 6. So 6 out of the last 10 years, you earned more than 2021. So even though you have a cheap price on the most recent year, you actually have a lot of years in here where you're earning more, sometimes substantially more, like $8, $6. At a $6 earnings like 2018, you're trading at a PE of 5 or you're trading at a PE of 6. That's actually really cheap. So this is definitely a cheap stock. Now you do have these years of losses, which you need to average into it, of course, and take that into consideration. But this 371, 372, and 148 can just average off against this 2012 number, and you have a really good number here. You're basically trading at somewhere in that 10 to 12 times earnings over an average, of course, of those years. But of course, if those years get better and better, if you start to get a few years like this $6, this $4.50 averaged in there, you can, of course, see again another way that you can get double-digit returns. They've been paying dividends this whole time, which is helpful as well. They did cut the dividend in 2021, so it's hard for me to just say, hey, let's add that in as a little incremental amount. $1.40 would have been, 2, 3, 4% in dividend yield that we could rely on, but because they had that most recent dividend cut, I'm not really going to take credit for that. I don't want to take credit for dividends that might not be there, even though a 35-cent dividend on a $36 stock is about 1%. So you could say, hey, I'm going to get maybe a 1% dividend. Not opposed to that, but it's not something I would rely on. Overall, interesting. Just an average business so far, but there's a lot of incredible numbers here that says, hey, this could be a cheap stock, and especially if the oil market continues to improve. It's kind of my base case expectation is that the oil market's kind of tight right now. If that continues to improve, if the oil industry continues to have good capital discipline, you could get a really nice return of this investment. So if you're learning anything from this video so far, hit that like button. Don't forget to subscribe, and let's go learn more from these financial statements. Let's go to the income statement. One thing you'll see is that your cost of goods sold, bounces around a lot. Again, their input, their cost is the oil price. So the barrel of oil is what the cost is for the refiner. So they're having to buy oil at high prices here. They were able to buy oil at low prices here. And so what they're earning is they're earning the spreads between these, the oil input and the gasoline output. And that's where they really make their money. But anytime you have these big, wide-ranging cost of goods sold changing, it also shows you're going to lack that pricing power. You're going to lack the ability to force that. Now, this business could be totally different. If they had this varying cost of goods sold, but they were able to maintain stable revenue, that would mean they have incredible pricing power, but it's not what we see here. This is a competitive business. SG&A has tripled over the course of a decade. That's a little bit of a concern. Other operating expenses have about 50%. You could say that's inflation. They do have debt, but the debt has not been very interest intensive, so I'm not super concerned there. And they've been buying back shares. So you can see about 20% of their shares outstanding have been declining over the course of the decade. That's going to add an extra 2% per year to your overall return as a shareholder. I like when I see this. I like that they're doing pretty steady buybacks. It looks like every single year besides 2017, 2018, their shares outstanding have declined. Well, no, there's a few years here where they didn't as well. So they bought back more shares at the beginning of the decade than the end of the decade. But of course, the returns were better then. So, say how it is. But overall, pretty good here. A 20% decline in shares outstanding adds about 2% per year to your overall return. What was the other boost that I talked about? So you had 1% here, this dividend. Of course, you had this potential 3 to 4% boost from margin expansion or multiple expansion. So inventory's doubled, 1 billion to 2 billion. PP&E has doubled, 3 billion to 5.8 billion. Goodwill's basically flat, so they're not making a bunch of acquisitions. Okay, so overall, nothing exceptional here either way. They don't have a lot of cash on hand, but no problems there on the asset side. Let's look at debt. So debt's up about 3x from 1 billion to 3 billion. This is the only downside I have is $3 billion in debt for an enterprise value of a $9 billion company. Again, you're at that 30% range. That's a lot of debt. That's a lot of debt for this business, especially with how unpredictable it is. I don't really like that the debt is up that much. It's just a lot of debt. Nothing else on the balance sheet. Let's look at the cash flow statement. So depreciation, amortization. Depreciation is basically doubled from 240 million to 500 million. You're seeing they're having to invest more in their PP&E over the last year or so. It's a little variable, kind of went up here and then went down for a few years. So it looks like their investments are following the capital cycle. This is a problem with a lot of cyclical industries. This is actually what causes a lot of cyclical industries is they invest when things are good. They don't invest when things are bad. It makes sense why that's the case, but that's also what drives the cycle. So this is just, again, kind of following the average. I don't know why they have stock-based compensation, but they've been paying out, about 40 million in stock-based compensation every year. So it means the years where they're doing big buybacks, like 210 million, 743 million, then the shares outstanding decline. But when they're doing small buybacks, the shares outstanding are flat or going up. So that's kind of where those two plays in together. One thing that's a big positive, though, is you see this cash flow from operations. So even in the years 2016 and 2020, when they lost money on a net income basis, they still had positive cash flow. That's a really good sign because that means it's going to be really hard for them to fail as long as they maintain positive cash flow. Now, certainly it can happen, but it's negative cash flow, which really destroys a business. But they've been able to maintain that positive cash flow. So you got this debt, kind of paying debt every year. The dividends. So again, all this is just kind of reinforcing this is an average business, balance sheet, average business, income statement, average business. The big story here with HollyFrontier is this is a cheap price. So if you're going to be a shareholder of HollyFrontier, you're basically buying for price. You're not necessarily buying because you like the business. Maybe you buy it because it's a cheap price and you're making a specific bet on the future of the oil industry. That could seem reasonable. That makes sense to me. For me, it's not a watch list stock because I want more of the higher quality businesses, but I can certainly be impressed with the price here. I can certainly understand how you can get to sort of double-digit returns. You get this 3 to 4% boost from multiple expansion. You get a 2% boost from buybacks. You get a 1% boost from dividends. It doesn't require a lot to go right to get my double-digit returns here. And certainly there's ways you can lose money here, but overall I think I can see past double-digit returns. It's just not as high quality as I'd like for my watch list, but I think it could be interesting for shareholders, especially those that really like oil and gas industry and want to make a specific bet in this industry. So worth doing further research. It's certainly one I wouldn't pass out of hand. And that's my summary for HollyFrontier, ticker HFC. If you enjoyed this video, hit that like button. Don't forget to subscribe. You can check out all my watch lists in the stock playlist up above. And if you like this software, quickfs.net, and you want to do your own stock research, my affiliate link is the first link in the description below. You can get a free account there to study stocks. Thank you for listening, and until next time, stop paying fees, start building wealth.